All right, welcome back to another Stock Talk Live. I'm Jesse, and today we got Bacon Memes, Bacon, Baconator, whatever you want to call him. He's been a member of the Discord for a while and various communities, so it's always fun to get to chat with him and have some stock discussions. So yeah, today is going to be a good one. We're going to go over Verizon, and I realized that I'm a horrible YouTuber because I scheduled a Verizon live stream when we had like Google and Microsoft reporting. So yeah, bacon. Fruit hat.
Good
How's it
old
going,
fruit
man?
hat.
Oh yeah, man. You got to regulate your comment spree though, Fruit hat. Okay, you gotta just you gotta be chill. Okay,
Take
no
it
more
easy, fruit
than
hat.
yeah, no more than one comment every 2 minutes, please. But man, how's it going, man?
It's going all right. Going all right. Yeah,
Yeah.
yeah. So, should we get into it, or did you want to talk about other stuff?
Whew, I don't know, man. Well, what was the drama today? We got Google is up after hours, right?
Yup.
Let's see if I'll share this. So we got Verizon up right now, but we got Google up nicely after hours.
Yup.
That was sweet. Nice move. Microsoft, I think down after hours, which cool. I'm not going to
Yeah.
complain with that. um, and then what? IRBT, that the acquisition play that just tanked today off of the
Yeah.
renegotiation of the bid. So Amazon basically was like, 61 a share, never mind. How about 51? And man, iRobot just tanked. So man, I should have locked in gains on this one earlier, I guess, but still sitting about break even, so it's not too bad. But yeah, the the risk reward there is much different now.
Yeah.
But um so Verizon, I think they reported as well. I didn't even know it. That's how good I am at coordinating these things. So Verizon reported Q2 today, 2023,
Yes.
and yeah, we'll go through that. We'll go through evaluation, talk a little bit about the company, and go from there. And I guess for the audience, like, what's your experience with Verizon? Anything at all? Any like customer experience, industry experience, anything like that? Have you looked at it much?
No, for me, no. I don't know about the audience though. Um,
Okay.
yeah, we'll see what everybody else is. No. Talking about Carvana.
Oh yeah. Carvana's up a lot, so
Yeah.
as usual. Man. So yeah, Verizon is I don't know, like it's obviously been on a horrible sell-off for a while now. I think we're down about what year to date? It's down about 14.66%. 1 year is down about 23.78%.
Yeah.
And let's see, 5 year, yeah, down 34%. So
Ugly.
it's trading at a PE ratio of 6.67. So obviously it's so cheap. Um, dividend yield, uh, dividend yield up at about 7.62%. So for those that don't know, kind of my career work background, I've worked for multiple ISP slash telcos in the past, specifically in engineering around kind of telecommunications, data transit, network architecture and engineering. So I do have a bit of a background through various ISPs and telcos. So I worked for one up in Alaska, worked for one down here, and some other companies kind of in this data communications, IP transit field. So I guess we'll just go into earnings real quick. I can't even remember. Did they beat? Did they meet? We'll see.
Uh,
Here's Verizon here.
I forget. I'm bad at this, and I'm bad at keeping track of analysts.
Yeah, no, me too. Let's see, earnings whispers. What? Well, it doesn't even say, does it? I don't know. Consensus 117.
Okay, yeah, they beat.
Uh, 5. That almost doesn't even look like the actual price of it. I want to make sure. I'll trust Google.
Trust Google.
So they beat on EPS and they missed on revenue. So
Yep.
beat bottom, missed top. 121 versus 117, and then expected was 33.32, reported was 32.6. So I pulled up some different things from their investor presentation or their investor website, looking over Q2 earnings. I think we can do the news release, and well, we don't even have to go through that. They're just gonna tell us what we're gonna go through over here. So essentially, this was for Q2, and they saw. I mean, it just doesn't look very good, man. Like,
No.
So consumer wireless retail postpaid phones saw a decrease year over year. Prepaid net adds saw a decrease year over year. Let's see, decrease of 304, decrease of 136. But then we have the business wireless postpaid, which saw an increase, and we saw a decent increase in broadband net adds. And so you were telling me that you recently got a kind of like a probably similar to a service what they would offer with Wi-Fi over wireless. Is that right?
Yes, but I got mine through a different company. But my
Yeah.
guess though is that they all do the same things, which probably explains why they beat bottom line and not so much on the top line with everything that we've covered. Because if you're able to just ship a package with all the goodies and have the customer do the install, then you don't really need as much of cost of goods with having say someone actually physically show up over there and doing the job. Um,
Yeah.
at least in theory, that's my thought. I could be wrong. It could be something
No,
else.
definitely. So and the service that you got, was that over 5G as well?
Yes, I think so. Yeah.
Yeah. Because I know it's basically just broadband access via wireless 5G.
Yeah.
AT&T offers it, Verizon offers it, T-Mobile offers it.
Mm,
I think pretty much all of the wireless players, telco players, are starting to go that route, which presents opportunities, but also presents challenges from, I think, a technical engineering standpoint. The opportunity is that it's going to be like, obviously it's way easier to potentially deploy, because as long as you have enough essentially wireless capacity, you can easily add people um, to those towers or wherever your wireless capacity is, and they get pretty decent speeds. Like, I don't know, do you know what you get?
not off the top of my head, but like even
Yeah,
at its worst, like it's far better than what I had before.
yeah,
Yeah.
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 So, and like I've seen, I think testing of like 200 megs down and like 25 megs up, something like that.
Sounds about right, actually.
So, and their latency is not going to be as low as something like probably a DOCSIS cable modem, which would be your typical like Xfinity or
Hmm.
Comcast cable service, internet service. So it's not going to be as, the latency isn't going to be as low as that, and their theoretical maximum throughputs up and down are going to be as good as that, but the ease of deployment is definitely going to help,
Oh
right?
yeah.
Um,
Yeah.
but they are going to have some limitations. But honestly, it's not. It's for certain people, it's a really good option, and on their side, they're able to offer a service at a higher. I believe that it's a higher cost relative to like the regular wireless services,
Yeah.
and have a little bit better margins on those going forward. Um, the thing that concerns me, all right, I'll get into the technical things for now. The things that concerns me about this technology in general is that I think people do not realize how difficult it's going to be to have the density and the capacity that you would need to have the majority of people in densely populated areas on this type of internet service
Mhm.
solution. So when you look at like Comcast or other, DOCSIS cable providers, a lot of times these providers are basically working with developers on net new builds of apartments and stuff like that, and pretty much pre-running their plant into these facilities ahead of time. So they have basically, you know, uh, direct access to land-based communications right off the bat. Uh, from the technical standpoint, their capacity is going to be way, way, way better than something like a cell tower. So they're going to essentially what it boils down to is they're going to have better capacity and they'll be able to provide better service to more densely populated areas if their plant infrastructure is already built out correctly.
Mm.
So I'm I'm still like on the fence of, is this going to be a good long-term thing? I think it's going to be really good for certain areas and maybe more like um rural areas or like the one-off cases where people like can't get cheap, affordable, you know, internet access via like coax cable or fiber.
Mhm.
I think it could be a really good option. And some people just aren't going to need the bandwidth upload and download that you would need from like a DOCSIS internet or a fiber internet connection. But it is interesting. But it looks like pretty much all of their growth, their saving grace is going to be in that broadband segment.
Yeah.
Um, and I think that could be really good potential. It could also worry me a bit because I would I would potentially kind of want them to be remaining strong on the wireless consumer side, and then kind of just adding net broadband users on top of that. And that's something that's pretty much what kind of T-Mobile is doing right now. They're stealing a lot of competition away from AT&T and T and Verizon, and then they're also going the broadband route. Um, so this just kind of concerns me. It almost seems like to me that it's going to be a question of can the growth of their broadband ads just offset their dying consumer wireless business? I don't know. What do you think?
I think you're onto something. I've been on record before having mentioned how like the broad strokes history, as I understand it, I could be wrong, but Verizon's uh, past R&D was more focused also with higher frequencies, like higher wavelengths, for say 5G rollout and whatnot. But the mid frequencies were what was needed all along, and of course Verizon has theirs, everybody has theirs, hell, even Comcast has theirs. So again, that losing that wireless customer base is very concerning, especially since I think I saw like a pie chart not that long ago where like high 70% of their consumer like revenue sources came from like wireless customers, I want to say. And again, the rest was like mostly business broadband, maybe. But again, I
Yeah.
could be wrong. I could be wrong. I know that it's
No,
a
that
notable
that
percentage.
sounds about right.
Yeah, yeah.
I
Like
mean,
it's concerning.
yeah, yeah. No, for sure.
Yeah,
I would definitely assume that the majority of their revenue is coming from prepaid, postpaid wireless plans
yeah,
at this point.
yeah.
Um, yeah, so I think we have what the interesting thing that I saw too was wireless postpaid upgrades
Yep.
was down 34% year over year. So like,
Yeah.
people like usually go through upgrade cycles, and most likely like last year people were going through an upgrade cycle, and now they're most likely gonna dwindle until that next upgrade cycle.
Yep.
So the tailwinds or like the benefits from the revenue standpoint a year ago from all these postpaid upgrades might yeah, we might not see that for another year or two.
Yeah.
If it, well, it should come back, but yeah. And just wireline. So this is the biggest problem I have with,
Hmm.
not the biggest problem. This is another problem I have with Verizon. Um, their wireline access for their broadband is FiOS and DSL, and FiOS I believe is fiber internet access. Which, I mean, fiber internet is great. It's awesome. Um, Typically what I've seen previously is sometimes it can be harder on, I don't know, like harder on the deployment of the infrastructure for fiber and not as cost effective than going with something like a DOCSIS solution
Hmm.
with coax, where you have nodes and it's basically has way better reach. Not better reach, sorry, that's the wrong terminology, but potentially better density as far as like extending fiber to a DOCSIS node that's in a neighborhood that then serves like 200 people, 200 houses, right?
Yeah.
Um, and is like coax is not as delicate as fiber, right? So fiber can break easier. So I just don't know. I'm not super sold on the FiOS solution, and then DSL just sucks. Like, really? Like, why are we saying FiOS plus
Plus
DSL?
DSL.
Like, you gotta be kidding me. Like, really? Like, just shut up. And then on top of that, I think with the fixed wireless access broadband, another competitor that I think is going to really challenge these wireless providers for this type of customer is going to be Starlink.
Oh yeah.
Like,
Yeah.
low Earth orbit is going to be, um, I mean, if they can get the price down,
That big if, but
it's
yeah, I
yeah,
hear you. I
yeah.
hear you.
If they can get the price down, right, and they can scale, they're going to be a direct competitor to this type of an offering. So it's almost like they have to come in lower than cable in areas that maybe don't offer cable DOCSIS, try to get customers, but then they're going to have capacity and density restrictions um, in order to compete with cable, DOCSIS cable. And then if they ever went the route of trying to like there's no way that they would build out their own like DOCSIS cable modem network or cable network, because it just would not be like, oh my gosh, it would cost so much freaking money. So I don't know. I think, man, it could be one of those things where like this is what keeps them alive, or we could like in 15 years being like, oh, remember all those wireless providers are like non-existent anymore because they tried to compete with like ISPs and ISPs just wipe the floor with them. Yeah, I'm very like, but for now, it seems like it's almost the direction they have to go um, at this point. So, and when you were talking about their high band frequencies
Yes.
focusing on 5G, so
Yeah.
for the audience, basically, there's different bands of frequencies, especially for 5G architecture. There's something that's I'll call it low band, mid band, high band, and ultra high band.
Yep.
And essentially, the higher the band, the uh, basically the more throughput you can get, but the range is going to be less, and it'll be more susceptible to interference. So it like won't go through like a building or something like that. So if you look at what some carriers did, I gotta be careful about how I say this. Um, some carriers did is they focused extremely heavily on that high band solution for 5G and really wanting to be able to bring that density, not the density, but bring that speed to smaller regions. And usually that was best in like highly dense, highly populated areas. And that's usually also best for offering things like broadband internet. And then other carriers went with a quote unquote like more balanced approach and they layered low, mid, high, and ultra high, basically at a much easier, better rollout. And what that gave them is the advantage of being able to service customers, I would say, better in a variety of situations.
Okay.
So low band, you would have really not as high capacity for throughput, but you would have really, really, really good reach for those customers. So you wouldn't have issues like, the frequency going through a building, right? They'd have cell service in the building on 5G, or the service, outside would be able to reach like really, 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 really far. Um, and be really kind of like high availability. Now you wouldn't be getting like 300 megs down on it, but you would have a very like solid service. So each carrier, AT&T, Verizon, and T-Mobile, all of them kind of had different strategies, and we'll see how it plays out. I personally have a bias where I think I think one specifically did it better, and is in a better position. But we'll see. We'll see if that plays. And yeah, no, it's not AT&T or Verizon. So
There goes the moving bus.
So we'll just put it that way. So yeah, that's a little bit, I don't know, a little bit about my thoughts on the industry in general and some of the things that I think they're going to have potential issues with, some of their opportunities. And we can kind of get into maybe their structure right now. I'm going to move this real quick so I can see.
Yay. I love this part.
Oh my gosh. I might have to time out somebody here.
Uh-oh.
All right. So first off, let's go and let's just appreciate that massive amount of debt that
Yeah. Oh,
Verizon
yeah.
has.
Ginormous.
So my data right here is probably gonna include this recent quarter because I don't think it's populated into my service yet. But yeah, they have 162 billion in debt, which is absolutely massive. Cash and short-term investments is what, 2.2 billion. Lordy, oh my gosh. This is insane. Okay, sorry. So something to note is when we look at their debt structure, you can pull this up on Verizon's investor relations page. We can see that they do have about 11.51 billion in debt coming due within the next year.
Yep.
And then we can look at their long-term debt. We can kind of see the interest rates that they have. And does this go by? It's kind of sporadic. So
Yeah.
if you really wanted to, which would probably be a good thing, is to almost look at all of this debt in the years that it expires and go from there. I would hope they would have something like this in like a 10K or a 10Q. That is easier to read. I guess you could export this to Excel and just sort by that. But
Yep.
so yeah, Verizon's debt structure, like if you're gonna mess with this one, you really need to have a good understanding of that and a good comfort level with how much debt they have, because all that debt that they're gonna have to roll. Let's see what's the interest rate on that debt. Here we go.
Oh.
Ooh, 0.375%,
Yep.
1.625, 0.750. And
It's all
then
right.
SOFR, I'm guessing that's something like a LIBOR plus 0.5%. So like
Yes, it's modified. I forgot what SOFR is based off of, but it's very similar to LIBOR, whatever you pronounce it.
LIBOR, yeah.
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 So basically, holy cow, all of this debt, if they can't pay it off, which I don't know, I don't think they're gonna have the cash flow to pay it off. They're probably gonna have to roll it. They're gonna be rolling that. It's gonna be a lot more than 0.375% interest coupon, right? So interest rates have risen a decent amount. If we look at what is it, macro, is that it, or is it macro,
Macro trends?
micro,
Oh, okay.
macro, micro? All right. If we look at the current rates, this will load. What are we sitting at right now? So current Fed's fund rate is about what, 5, something like that.
I think so. Ish.
Yeah. So 3-month is at 5.42, 2 years at 4.9, 10 years at 3.88. So yeah, they're gonna have to roll some of this debt. Their interest expenses are gonna increase off of that roll, which is going to essentially reduce their cash flow. However, with that being said, the market's always likes to trick people, right? So that could essentially be priced in right now. If we get into an environment where could be, if we get into an environment where interest rates start dropping, well, inflation starts dropping, and then the Fed's like, oh crap, let's drop interest rates. Then the market could be like, oh, you know what, 162 billion in debt isn't as risky now. So we'll see. I don't know. It's a ton of debt though.
It's okay. They have what, triple B rating for their
Are
credit
they?
rating?
Are they
I can't
triple?
remember. I can't remember. I think they do it by segments.
There we go.
So it's
Triple
yeah,
B.
yeah.
S&P. I thought you said triple D, and I was like, that's really
Oh
bad.
no. No, they're
So they're
not that
triple
bad
B
yet.
plus,
Yeah, they're not
B double A,
Yep.
and A minus. So yeah. Okay. All right. So operating cash flow. I don't know if we saw that in a presentation or let's see. Operating cash flow year to date is about 18 billion, compared to 17.7 billion from year to date of same period in 2022.
Yep.
We can see that their operating cash flow is right. It looks like it's between about 10 to 8 billion a quarter. And then, oh man, good old communication providers. I mean, we're basically looking at a utility. I mean, right? That's basically what it is. Super infrastructure spend heavy. Now, man. So we have lots and lots and lots of debt repayment, dividends paid, obviously, from the free cash flows. So that's how most of their capital is being, or their free cash flow is being distributed, is to maintain that debt, pay out some dividends. But yeah, it's just a bunch of debt balancing right now. The thing that does intrigue me is that I wonder if the technological increase with 5G, along with them basically upgrading a lot of their plant to fiber, I wonder if that's going to have the effect of where in the future you have less capex requirements for infrastructure upgrades, because for those not familiar, fiber that was around 10 years ago, essentially you can almost, through the increase in technology in optics, where you transmit the light over the fiber, you can basically push more data through the exact same fiber. So it makes me wonder if we potentially have a scenario going forward where maybe their capex isn't as intensive, to kind of meet up with demand, but I'm not super confident in that assessment, honestly.
Yeah.
It's more of just a thought.
Anecdotally for Verizon, they gave a tiny amount of color on the whole lead thing. And by tiny amount of color, and by tiny amount of color, I mean that the CEO and CFO talked about how they don't know the exact numbers yet. They insist it's a quote small percentage. They refuse to give any numbers. and they said, too early to tell. We're gonna have a third party, coordinate with that, and then we'll determine a plan from there. So they can't even give a proper timeline for any of this. So we'll see if it's a nothing burger, as some people may think. We'll see if it's a really really big deal, and everyone should panic. I don't know.
Yeah. No, that's an interesting one because like, what AT&T and Verizon got hit with the same thing, right?
Yeah, I think so.
I don't know if T-Mobile was subjected to it. Honestly not sure. Which I think T-Mobile is decomming a lot of the old infrastructure that they took over from Sprint as well.
Hmm.
Um, so maybe they avoided that, but yeah, I don't know. Like that's a hard one because it's like, I what exactly? Uh, um, how bad do you think it could be? Like,
I have no idea. Because it sounds like some of the stuff that they referenced like dates back to pre-founding of Verizon. So like how one of the parts of Bell, uh,
mhm.
helped forge into Verizon. Like it seemed like some of those like early assets were are what's involved, and yeah, like that. This is far beyond my scope. I mean, like
Yeah.
part of my prep, not to like muddy the thing even more, but part of my prep was to take a look at like say the governance structure of the company. And one of the immediate things that I noticed was insider transactions. Directors and C-suite get a thing called phantom shares. I had no idea what that
Ooh.
was. Yeah, it clearly says in the forms when you look at SEC Edgar,
It's like
phantom shares. Yeah, and then there's like a
nobody
little
knows.
there's a little footnote that says like something to the effect of like the older transactions. They'd say that phantom shares would equate to a common stock. It's just that it would be registered as accounts payable for when the C-suite or director like leaves. So that's something to consider going forward. I don't think that the share
Interesting.
dilution like was noticeable or alarming, but that is something to be concerned of as far as going forward if you're a shareholder or interested on the sidelines of the mechanics of that and how that play out going forward. Um,
Yeah. So do they count the shares in the fully diluted shares outstanding as soon as the phantom shares are issued?
Again, that I do not
Because
know.
I,
Like,
I I know that I have seen some situations where like a CEO leaves and upon
yeah,
leaving,
yeah,
like he's
yeah.
awarded like a
Mhm.
ton of shares. Um, I didn't. I don't know if they're called phantom shares or
No,
not.
because like generally speaking, I'm used to like your stereotypical options and RSUs, restricted,
Yeah.
stock units. But yeah, these were clearly annotated as phantom shares under the SEC filings. And again, like I'm not sure how the accounting mechanics play into all that. So there's just like one of those things where I like was doing my early digging and I'm like, huh, that's neat. I haven't seen that before. Good to know.
Huh. Yeah,
Yeah,
that
yeah,
is interesting. That's very interesting.
yep, yep. You
Um, let's see.
find fascinating
So,
things even with these companies.
uh, yeah, I it's never ending, man. It's never
No,
ending.
no.
Um, so getting back to let's see, let's get back to Verizon for a little bit. Like just looking at some of the numbers, like um, I think their dividend payout ratio is actually pretty dang reasonable. I think it's like 50 some percent.
Yeah,
And then dividend payout ratio compared to operating cash flow is pretty reasonable as well.
yeah.
However, like there's
Mhm.
so much debt that like almost the biggest risk of the dividend being cut is not only like the regression in like revenue or the decline of the business, but also like just the debt risk that they carry, especially with rising interest rates. So while it looks good right now, like I could definitely see a scenario playing out where like you're like, oh, it looked good in 2023, and then 2025 comes along, and it's
Yeah,
like an 80% payout ratio, and then they're cutting the dividend, and then they're doing all this stuff because they just have a fundamental decline in the business, like along with their debt being out of control. Um, you operating cash flow per share has kind of just chilled. It had a decline going into 2016, 2017, and then
Yep.
rose up a little bit. On a dividend to operating cash flow ratio, it's about 29%. But that's, like I said, we can't really pay too much attention to that. And then the actual dividend payout ratio is about 55%. And it has been like a steady grower, and they've actually maintained a pretty steady payout ratio over time. Let's see. So 55%, and over 10 years ago or so, it was about 66%. So it seems to like they are pretty good at monitoring that dividend payout ratio between 50, 60% historically. They're what's I gonna say? They're looking at some of their leverage. Um, their interest expenses. Their operating cash flow to total debt is actually like, okay, I guess not horrible, maybe, but we can see it's kind of been declining over the last since 2018. So I mean, I made this term up so because I like making terms up because they make sense in my brain. Um, and so this is what I call just cash flow coverage ratio. And it's where basically so in this year in this year, their cash flows were about 30% of their total outstanding debts.
Mm.
Right. So their cash flow is equal to 30% of their outstanding debts. So for a cash flow coverage ratio, in this case, how I define it, like it would be better to have a higher cash flow coverage ratio
Yeah.
because it means that you're essentially way, way, way less levered. And then interest expense ratios as well. So an interest expense ratio to operating cash flow essentially is looking at the total interest expenses paid compared to the operating cash flow on a percentage basis. And what would you know? You can see that since 2016, 2017, in this like low interest rate environment, they kept on going down and down and down and down and down, right? So it's fairly low right now, but then it also runs the risk of, depending on their debt structure and how fast they have to refinance all or like restructure a lot of these debts, if they can't just cover them, we could see this creep up over the next couple of years as those debts are coming due and they're getting pushed out from what was it, like 0.5% interest rate to 5, 6, 7. so we could see that creep up, which would basically not be too good for their actual cash flows and being able to control that debt amount and eat into their debt. But I believe, and now I think you listened to the call, or a call. I didn't. I'm a bad investor. I didn't. So, I believe that they talked about kind of the plan to get their debt reined in a little bit, and also probably capex decreasing. I think they just kind of got through a decent capex cycle over the last couple of years.
Mm-hmm.
So did they give any insight into that?
Not that I recall, but then again, they covered quite a fair amount of ground in that. I only gave it a one-time listen through. If I'm doing serious due diligence, I try to listen multiple times because I am dumb, not because I'm that great as Jeremy. Wait,
man.
Wait, I shouldn't criticize my name by category. There we go. That's my fault.
Well, you can't just listen to one earnings call and be like, oh my gosh, guys, it's the next whatever.
No, in hindsight, I probably should have also had the transcript up, but
no, it's fine, man. I also did not prepare for this a ton, so this is almost like a live show of not knowing anything about a company and just what I would do. so, so
No,
look through it real quick.
it's good though, because like I was actually gonna like if we were struggling for time, I was gonna ask, like, since this is your expertise, what would you say would the key metrics be they accounting or finance related, that you consider very specific to this sector or industry, and then what do you think are like non-negotiables that translate across every industry? Uh,
Oh man.
yeah.
Well, I mean, for this industry, I would say both like ISPs and telcos, like almost anything utility related, you have to like I would say be pretty critical about their debt loads and their debt structure.
Ah.
Because that could crush them. Like it really could.
Yep.
Like the fall of these companies could be not managing their debt correctly and then going through a decline, and not being able to basically service that debt. um it's hard because like you want to see consistency in their leverage ratios when it comes to debt to operating cash flow, throughout multiple capex cycles, as they're continuously upgrading, I would say like plant equipment, stuff like that. um it These are like harder ones in my mind. This is like hard These are harder companies to like really evaluate because um there's just a lot of that like heavy debt load, that heavy spend, that heavy capex cycles for infrastructure. And then um just those factors in combined are gonna like, I think, like reduce your multiple a lot that the
Mhm.
market's gonna give it, right? Like which we can kind of see that over here is like um Verizon over the years has basically traded like around a yield of what is it? Probably 7 to 10%.
Yeah. Yeah.
Um, and it's trading like relatively cheap to historical multiples, but is it cheap for a reason? That's kind of the question.
Mhm.
Um, they haven't done a ton of dilution other than like 2014,
Yeah.
but they're not really a big uh, repurchaser of shares either, right? So,
Yeah.
uh, yeah, it's just ugh,
Yep.
uh, it's it's interesting because I'm like, if it gets to the well, and I think it did get to the point recently. It got down to like 30 or something like that,
Yep.
um, and the dividend was around like 8%. And at that point, it's almost like, okay, can they just maintain that? Right? And if they can maintain that and even just grow it a little bit, like eventually we'll probably get like some uh I don't know, multiple re-rating. Because that's basically, I think that's priced in for like deteriorating, like negative growth essentially on the bottom line. Um yeah, so I don't know. On the do you want to get into the valuation and we can just do like a really dirty quick eval on it?
Yeah, sure, why not? I think I
Okay.
noticed people also asking for AT&T because they want us to suffer. Because why talk about one bad telecom when you can talk about two? Everyone
So
wants their value.
I looked I looked at AT&T's numbers briefly. I vomited a little bit and then I stopped. So like everything that I'm concerned about with Verizon, like with AT&T, just multiply that by like 4, I think.
Yep. Just
That's
turn the knob.
I was like, I don't know. I don't know. So, but I have looked more seriously at like Comcast,
Mhm.
just because I think, I don't know. From my technical background, I feel like those companies almost have a larger advantage than wireless providers when it comes to what I believe will be a better sector or a better service going forward, which is going to be internet um, service versus wireless service. Um, because it's pretty easy to team up and do like a what is it, a VMMO partnership
Oh
between
yeah.
like a Comcast and like a Verizon or a T-Mobile or AT&T and offer that wireless package as part of your services, it's much harder for a wireless carrier to offer um, internet services that are broadband based, like actual like physical lines. I would say that the cable providers, part of their moat, if you could call it the moat that they have, is that like it would just be so like stupid for any company that is a wireless carrier to try to extend physical plant to compete with the guys that already have the plant there.
Yeah.
It's just too big of a hurdle. Like, you think Verizon's debt is bad now? Like, they'd like triple it. Like, let's go.
Oh, but zoning is real easy.
It'll be fine. It'll be
Yeah.
fine. Yeah, no worries. So, all right. Anyway, let's let's get into the valuation. So as we can see, like EBIT, net, and free cash flow yield averages over the last like 5 years are just everywhere.
Yep.
So what I wanted to do was really kind of focus on just one of the bottom line numbers. And in my mind, I kind of wanted to go with net income because the cyclicality of the capex spend affecting, and especially like the debts as well affecting the free cash flow can kind of be, I think, a little off here and there.
Yeah.
Kind of mess with those numbers. So I wanted to just do it by net income. I feel like that was like probably the easiest way. And we can kind of see previously the yields for net income have kind of gone between maybe 5 to 10%, sometimes up to 13, 14, kind of moderated, but it kind of seems like maybe the average is right around like 7.8 or so over the last 10 years or so. So in the best case scenario, I think I've got the net yield. I don't know. We could maybe change that, but in the best case scenario, we could say potentially we have 7%. Let's maybe like, what is that net yield? -1. Maybe. Now the issue that I have is that the revenue growth is essentially lower than inflation. Like, they're not even keeping up with inflation.
I don't see a problem with this.
Their net income growth is what, negative? No, maybe.
I also don't see a problem
Yeah,
with this.
negative. I mean, that's kind of like a one-off in 2017 where I'm getting the data from, though. So
Yep.
maybe I could like change that. And man, it's just ugh. Like even if we look at their margins, their operating margins and their net margins have kind of just moderated. They've been pretty flat. So maybe they grow at the rate of in their revenue. Like, oh my gosh, I don't know. It's a hard one to digest. -15. I also do not know what I would have to get in order to actually like what my hurdle rate would be like on this, because like 7% dividend plus 10% target rate would be about 17%, but
Yep.
I don't know. I don't know what type of margin of safety I would want there. It could be more, honestly. What do you think? What, like, if you're looking at this, like,
I
at what point would you be like, okay, I'm enticed?
I would have ran for the hills already. Not gonna lie to you.
Yeah, yeah, man.
I can't even like think of a good number to throw in for a hurdle rate on this. I can't.
Yeah. Well, and like, see, that's the hard thing is like I think that like they could potentially go through a period of like actual negative growth.
Yeah.
And like if they go through a period of actual negative growth, right? Well shoot, like everything just gets blown up.
Yep.
If they didn't have any growth at all, it's minus 2.22. If they had no growth at all, under these multiples, and then like maybe we're looking at 32 to 34. So maybe that's what the market's pricing in right now. Maybe the
Yeah.
market's pricing in like, no growth, essentially losing customers to other competitors, offsetting the decline in the consumer wireless segments with an increase in wireless broadband segments, and requiring a risk premium above because of their debt load. And that gets us to like, $34, right where we're at right now for the base case, 32.17 for the bearish case. It's just hard to like, this is one where there's like so many variables and unknowns that it's hard for me to be confident in it. And I feel like that's saying something, because I feel like I have a pretty good understanding of this industry.
So this is one of the rare cases where the novice, being myself here, wanting to avoid this, actually lines up with an expert.
Like, I think this is where I'm at with it. I already have Verizon in some of my index funds that
Yeah.
create a decent chunk of my portfolio. So I'm not just like jumping over myself to overweight this,
Yeah. Oh yeah.
Um, if I did, I think I'd like take a little bit, and just plan on, it being a dividend payer and watch the story progress. And maybe it turns out good, maybe not. It I feel like this would be one that like if I got into it and it like jumped up for some reason or whatever and like went to, mid 40s or low 50s, I'd just be like, okay, I'm out. Like, peace. you know because there's just like I don't really like the business model like overall. Like, I don't know. That's where
Would
I'm
you
at with it.
would you think or react when people say Verizon or like telecoms are, quote, like a bond proxy?
Mm, mm, no, I don't think so, because, well, I kind of get what they're saying, and they're I feel like when people say that, they're saying like dividend payers in general are kind of like a
Mhm.
bond proxy. Like, you could say like SCHD is kind of like a bond proxy, right?
Yeah. Yeah.
Because it pays about a 3.7% dividend.
Hmm.
It's fairly diversified. No holding is over, I think, 5% of the portfolio, or of the index. So that can kind of sometimes be like similar to a bond proxy. When you say specifically like Verizon
Yeah.
or like a
Yeah.
single company is like a bond proxy, I'm like, not really, because there's way too many like individual risks
Yeah.
for it to be a bond proxy. Like, um that that actually brings up a good point. Maybe you don't want to buy the equity, but maybe you buy the debt,
That it's a possibility. I mean, so long
right?
as it's
Maybe
secured.
this is,
Yeah.
if it's secured debt,
Yep. And you know what
maybe,
it's secured by. Yeah. Like
yeah.
maybe.
Because in the worst case scenario, the debt holders, secured debt holders, are going to be paid back first before, obviously, like investors, equity investors are just going to get
Hmm.
you know, they'll get what they get.
Oh yeah.
but
Yeah.
but maybe it's one of the cases where you say, from a debt perspective, maybe I want to invest in the debt
Yeah.
itself. Um, and that should be yielding probably a decent amount, I would think. But I don't know. I wouldn't say this is like a bond proxy at all.
No. No. If
Because,
anything, maybe levered bond proxy.
yeah, yeah. Well, I mean, technically, like a highly levered, uh, triple B plus bond proxy, right? So, like, if you're getting like in the junk bond area, like,
Yeah.
like, maybe like a junk bond proxy, sure. Like, but if you're saying that it's like it's like a bond proxy compared to like, you know, the treasury rates or something. Nah.
No, no, no.
I don't know. That's how I would think of it though. But
I agree, McBruity. Based off of those numbers that you just gave in chat, I'd be hesitant.
yeah, 5 to 6%
Yeah, that's
on the debt, that
yeah,
wouldn't make much sense.
no
Like
thanks.
why would I do that when I can get like a freaking savings account at 5%?
Yeah,
Like you know, yeah, it just doesn't seem like
yeah.
the return would be there. And in that case, I mean, like, I mean, I don't know. I would almost prefer the equity over the bonds at that point, because I'm like, well, if I really believe that they could maintain their dividend ratio and they're going to like they're under heavy negative sentiment right now, and they'll be able to just kind of putz along, like, okay, maybe, but if that's not the case, you know, and this thing goes to $20 tomorrow, then you're like, oh crap, you know. Oh man. No, I agree. I don't think it's really worth it on that.
No,
So
no.
yeah, I don't know, man. I think if this thing ekes out any type of growth over the next 5 years, the chart is gonna look beautiful. Because I don't think anybody is expecting it to. I
Yeah,
don't think the market's expecting
no.
it to.
Um,
I I don't like. I think if this thing ekes out, oh my gosh, like if it eked out like 3%, 4%, 5% growth over the next 5 years, it's gonna be like, oh my god. But
it lives.
it lives. It's gonna be the next big thing, man. It's gonna be the Tesla of telecommunications company. Oh man. But you know what? Hey, this is actually I would think you have listened to Aswath Damodaran, right?
Yes, yes,
And his company life cycle phases.
yes. Yeah,
I feel like this is a
yeah,
perfect example of that end of life company where it's like it's grown to be all that it can be, and it's going to be just basically returning cash flow to shareholders. It might have a terminal rate, but honestly, it's probably going to be ousted by new technology.
yeah. Let it go. Uh, sell what you can. Sell what you can. Spin off what you can. Maybe there's something in there.
Unless, I mean, honestly, this is probably the time for them to do heavy R&D and like try to figure out kind of like what is going to be their business drivers for the next 20 years.
Yeah,
That's probably the best thing for them to do right now. Pay out the dividend, and then really look for that next 10-20 year cycle of how can you provide value and hit that next leg of the business. Um, but yeah, just put a 12, 14, or 16 PE on it and McBuddha, call it good. Oh, just put 10, 12, 14, 16. That sounds familiar. I wonder who uses that methodology. I don't think you can go wrong though, right? Like, oh man.
so that's I will say though, like if the earnings call is what they truly mean going forward, by they I mean the C-suite. They did mention the word discipline a lot, and it seems like they are tilting more towards focusing on costs and being
Yep.
disciplined there. So we'll see how that is going forward. But I agree with you though. They do need that right balance of lean cost perspective, but also they still need that top line. Like
Yep.
I'm not gonna say they need to go crazy, like plastic surgery, so to speak, and like
They
like
just need to
being an
mention
old company.
AI
Yeah,
more.
they mentioned it like once or twice, I think. Like
Oh,
not that
really?
much. So yeah, yeah. I think that like it got
Their new
mentioned a little
product
bit.
will be Verizon AI. We're listening.
Yeah, so that's. But like yeah, there's there's reasons from my opinion to think that this company isn't necessarily dead, but yeah, it's not one that really interests me all that much.
Yeah. I,
That's
I don't think it's dead. And I think you're like spot on, man. It's gonna come and management was spot on that it's gonna come down to like efficiencies
yeah,
through operations, through CapEx,
yeah,
through everything. It's really gonna come down to those efficiencies that they can gain and how they can, use hopefully the improved margins and the capital that they gain from those efficiencies to really tackle like, kind of some of the fundamental issues with their financial structure right now.
yeah,
Um, because like if they're able to do that and they're able to start like the dividends safe, they have stabilized like you know customer base. Broadband is definitely going to like make up for any issues, or the wireless segment in general like gets back into like a moderation slash growth phase.
mhm,
Um, and they're able to really tackle and deleverage. Yeah, that could be like that. That would obviously be like a recipe for
yeah,
success.
yeah.
And if that does happen, we'll be looking back in 5 years, being like, oh man, like we could have bought that at $30 or whatever. Like,
Oh,
uh,
here's a little technical business thing. Because I think if I heard correctly, the earnings call they mentioned how like they were going to try and like either limit or not do promotions going forward. Um, Out of all like the
hmm.
promotional models out there, what do you think would be the best for business? Like do it be it like buy one get one for unit sales, or like discounted teaser rate, or mail-in rebate, or something else.
I'm not sure.
Naturally it depends on the business, of course, but
I'm honestly not sure. I Oh man, there's so many promotional. Like, are you talking about specifically for this industry or just in general?
between Verizon and just in general also. And again, I
Yeah.
imagine that it would definitely depend case by case. 'Cause-
Well, I mean, there's always like the main promotional um offerings is usually like, hey, come to us from another carrier and we'll give you like a iPhone Pro,
yeah,
14 Pro or something like
yeah,
that, right? And so there's ways to tempt people like that. But I think what we're going to see is that like people aren't going to be as concerned about stuff like that. Um,
yeah.
and customers are going to value customer service and ease of customer service and response
Oh,
and stability and just overall like I don't know, like if you can make the experience for a wireless customer painless, like completely painless, like it's hard to put a value on that.
yeah.
And if you do that for people and they're impressed with your service, like they're most likely not going to like leave um, to go to another carrier that has poor quality and customer service for a
Mhm.
free phone, you know?
Yeah.
And it's really hard to build that.
Oh, yeah, yeah. Because that's one part reputational, and another part like that is an expense to have good employees, good training, and all of that. That's yeah.
All right. Well, it's getting late. I think we're gonna close it
Yep.
off. Thank you everyone for joining. Yeah, sorry I didn't get to go through your questions. I didn't really see too many questions. Just a lot of fun chats. So have a good one. Have a good week. We'll talk to you later and peace.